just kicking off on the Amplats story, I mean, just looking at the share price today, Amplats down, Anglo-American up 1.6%, but it seems like they're trying to send out positive signals now by saying that they've had constructive discussions.
I'm actually surprised the Amplats share price is down because it was up strongly this morning when they made the announcement. But yes, I mean, we know exactly what's happening here. They're going to lose 300 to 400,000 ounces of production. That will stabilize the market. That takes out the excess out the market. Also takes out Amplats' high cost or marginal operations.
How certain is this though? Because ultimately the government has indicated that they're standing their ground, well, appears to be, when it comes to trying to influence Amplats.
But of course they will. Governments and politicians, I mean, they can't come out and say it's okay to lose 14,000 jobs. They've got to make as many public statements and try their utmost. But Amplats is fully entitled to cut these. I mean, remember that 6 years ago, Anglo-American expanded their operations. In fact, over the last 10 years, they must have doubled production. And they've created a lot more than the 14,000 jobs they've lost now. So they created the jobs, the market changed, their costing structures changed, they're now downscaling. So this downscaling will happen. There is no question about it. I mean, Amplats almost went to the wall a very short while ago. They do the huge rights issue to actually stay in. And I mean, we all know what happened at Lonrho. In fact, Lonrho did go to the wall. They had to have such a discounted rights issue to even stay in business. So this is an industry, you know, in serious distress. You can't not cut back.
You can't sustain making losses, basically.
You just can't sustain making losses. You've got to do something to get the industry right. And the government does realize. I mean, forget what they say in a public forum. That's just politics. They know. I mean, there's the story of nationalizing the mines that they've closed and giving the mining rights to someone else. Do you think someone else is going to mine it if Amplats won't mine it? I mean, this is just politics again.
When it comes to the retail space, Truworths up on the day, expecting HEPS up 16 to 20% for the first 26 weeks, and talking about retail sales, 14.8% in the period. But worrying signal when it comes to concerns around consumer creditworthiness.
Yes, everyone's telling more or less the same story. So it's interesting, all the results that have come out from the retail sector. First of all, the official numbers. This is not borne out by what the retailers are telling us. It just seems way higher. So I think there might be a few gremlins in the machine there, and we'll see a rectification next month.
This is not the bottom line number, basically, what we're saying.
Yeah. Look, everyone's coming with exactly the same story, and it's not a good story. However, the results are fairly mixed. Most of them are negative. You can see Shoprite, some of these shares have come under big pressure. But you saw today, one or two come out with half decent results, share prices go up. Look, you've got to come with at least 15% plus growth in earnings to justify most of the retailers' valuations. And you see what happens to expensive shares. If results don't live up to the share price's expectation, they come under huge pressure, and quickly as well. Quickly.
And we saw what happened to Shoprite today. What about, I mean, Taste is a small cap company, but a very interesting one. And when you see 41% growth in December and the 4 months to December, 58%, almost 60%
but that's
year-on-year
acquisition growth. They bought the fish and chip company. But they are doing well. I mean, make no mistake.
Because they talk about, sorry, just to interrupt you there, but the food services side, flat growth if you take out the acquisition.
So, but I mean, the company's reasonably priced, actually. So it's not a bad way to get into that sector, because you know the other shares in the sector are actually quite expensive. I mean, the other ones are quite Famous Brands. Famous Brands is quite expensive at this level, even though it's got a winning product. It's actually quite expensive.
Let's turn our attention to US markets and what's taking place there, because broader sentiment is seemingly supportive of South Africa's market direction right now. The S&P 500 surpassing 5-year high. So what are your thoughts on the key factors we're looking at right now driving markets?
The S&P 500 is not where it was 12 years ago. So it's got it's languished for it's languished for over a decade, but it's actually cheap. It's cheap for good reasons, in that the US economy is not doing particularly well. It's doing better, as we spoke about earlier on. But compare it to South Africa. You know, you're getting if you compare the dividend yield in the US market to our dividend yield, it's one of the biggest differences ever. So the US market is actually quite cheap, and you can go there and buy top quality global companies with massive brand names who've been in existence forever at very reasonable prices. way below what our retailers are. So it's actually not a bad investment decision to take money overseas and buy into the S&P. And of course, if you're an American, you earn 2% on your bond, you earn nothing on your cash in the bank. The dividend yield's significantly higher than that. So you might as well go there and buy shares and just get the dividend and not really worry too much about the capital growth side of it.
Now, Morgan Stanley reported their results today. Those beat expectations. Yes. And the CEO coming out and saying that the rally we're seeing in markets has legs, quote unquote, and saying that they've got $1.8 trillion in assets and $90 billion of those just waiting to move into the market every single day, and just political uncertainty weighing.
Now look, you've got the whole politics, and we're not going to go through that whole long story again. But is the market cheap? It is. It's actually fundamentally good value. And it has got legs. Bull markets start from cheap valuations, and the valuation's cheap. Our market's not cheap, so we can't expect a bull market to start or be sustained from these valuation levels. But overseas, you actually can.
On the local markets here, I mean, what could push the local market further? Because pretty much at record highs, just kind of a few hundred or so points short of that. If you've got retailers which are coming under pressure now.
Resources can drive the market higher. Banks are fine. Banks are reasonably valued. They're not cheap, but 14, 13, 14 P is okay. The resources will be the driver, and the news out of China is very, very good for the resource shares. Once the local situation calms down and gets a little bit better, the Chinese inflation, as Colin was pointing out, the Chinese inflation is not particularly good news. However, in the US this week, food inflation dropped quite dramatically. Now that will eventually feed through to world food prices. So I'm not too worried about the inflation side. The only thing that can scupper Chinese growth is inflation. There's not enough debt to scupper it. It's actually the economy itself is in good shape, but higher inflation has a significant impact, negative impact on China. If inflation's under control, China will be okay.
We're talking about the Chinese government being the underpin of the growth numbers coming through, and you take that away if they're concerned around inflation. What happens there?
Every single major economy in the world, it is only the government that's behind growth. But China is different. Their government's got very little debt. So they can do this for a sustained time period. They're not like...
Barring the impacts on inflation.
Yeah, because inflation affects consumer expenditure. I mean, Japan, they've thrown everything and the kitchen sink at their problem now. And quite frankly, I'm not even sure this latest bout will even work. But China can do it. And more importantly than that, the consumer has got virtually no debt in China. So you can sustain consumer expenditure for a long time period. There's just it's not like Europe, it's not like Japan, it's not like the US, it's not like maybe even South Africa. There's very little debt in the system.
Let's just bring it back to South Africa. And which stocks have caught your attention so far this year? I mean, which stocks are you betting on? We've talked about resources,
well, look,
but specific stocks that perhaps not talked about often in the media.
Look, I mean, as you correctly said, we've spoken about resources. I'm still quite keen, despite the latest data on the industry, I'm still quite keen on building and construction shares. I think on the longer term, they represent really good value. I mean, we speak about it often, but heavyweight industrials are actually reasonably priced. Bidvest, Rembrandt, you can buy them with some degree of certainty of returns. The smaller caps haven't really made too much of a comeback on that side. There's nothing in particular that comes there, but the biggest single theme is low retail shares. You must be underweight retailers. These things probably have had the best they're going to have. The environment's not conducive to their massive
Depends
growth.
on your investment horizon, surely, because
No,
I mean, what about a ShopRite share? What, you sell out of ShopRite now as a kind of blue chip retailer in Africa?
It's very difficult to buy a share at a 30 PE.
Well, it's different between holding and buying, though.
No, fair enough. But it's difficult, put it another way, it's difficult to make money on a 30 PE share. It is just difficult. Now, I know it's higher, but Naspers the PE is in the same ballpark. But Naspers' growth potential in China, and that is just significantly greater than ShopRite's growth potential in Africa. I mean, it's completely different businesses in a completely different stage of their business cycle, and yet the market's pricing these two shares relatively equally. I still think there's a bit of downside. on the retail.
Which construction stock are you most bullish on right now?
Go for the not PPC. I'm worried about cement production. There's just too much capacity come on stream. So go for the quality stocks. Go for Wilson Bailey, Basil Reed. Wouldn't go for Murray and Roberts. Wouldn't go for Evans at the moment. So I'll stick to those.
What's
two.
wrong with Murray's at the moment?
No, look, they've just got too many hassles with
debt.
Their big construction projects. It's just too much uncertainty in there. They're heavily exposed to very, very large projects, and they've had a torrid time over the last couple of years on their big projects. I'll be a little bit cautious there.
But I mean, there's been, when it comes to the construction space, there has been some kind of activity when it comes to M&A activity.
Yes.
I think Afrimat today announcing that they're buying InfraSource. I suppose moving into the mining space as well, both of them. But does that signal to you that there's more to come of that in the kind of smaller player space, junior
in the smaller
players?
player space? I mean, remember, very similar to the dot-com boom, we had a building in construction new listing boom here, where everyone who had a hole in the ground or a shed that made bricks listed their company. And there hasn't actually been that much consolidation in that market yet. So I actually do expect more to come. I mean, a few have gone bankrupt, but there hasn't actually been that much consolidation.